Now, without further delay, let's begin today's event, sponsored by CoStar and hosted by Accounting Today. I'd like to introduce your moderator for today, and that is Danielle Lee. Danielle, you have the floor.
Thank you so much, and thank you all again for joining us today for today's webinar, Lease Accounting Fallout from COVID-19. Before I turn it over to today's presenters, some CPE information for you. Verizon is pleased to be able to offer CPE for this web session. It is imperative that you adhere to the following instructions to obtain CPE credit. To receive credit, you must be in attendance for a minimum of 50 minutes. No credit will be awarded from watching the replay. Accounting Today is not responsible for late arrivals or connections issues. There will be required polling questions asked periodically throughout the session, all of which you must answer. Please remember to click Submit after choosing your answer. If you have completed the above, please allow up to 3 business days from date of today's session to receive an email from simplecert.net. This email will contain instructions on how you can download and print your CPE certificate. To ensure email receipt, please add simplecert.net to your safe sender list. Please note, CPE certificates will only be sent to those attendees who have registered and stayed for at least 50 minutes and answered all required polling questions. If you are watching in a small group, the person logged into the program is the small group facilitator. He or she must respond to the polling on behalf of the group and must monitor, document, and verify the active participation of the individuals in the small group. Please have the small group facilitator email support@simplecert.net within 3 business days a list of names, emails, and company of those registered in the small group for them to receive credit. And now to introduce today's presenters. We have Matt Waters, CPA. He's Director of Lease Accounting with CoStar. Matt is the former Lease Accounting Manager with Home Depot and American Tower with 15 years experience. We also have Tim Colbert. He's the Managing Director at Deloitte. He's the leading firm expert on lease accounting and has 20 years experience, 14 of those with Deloitte. And my name is Danielle Lee. I'm the Managing Editor of Accounting Today, and I will be your moderator today. And with that, I'll turn the floor over to Matt to begin today's presentation. Matt?
Thank you, Danielle. This is Matt, and I'm happy to be here today. Thanks to everybody for joining in. And before I get started, let me just say a special thank you to Tim Colbert for joining us today. Tim is one of the most esteemed lease accounting experts in the country. So, Tim, thank you so much for being our guest today. As we look at and think about COVID-19 and lease accounting, I wanted to start off with this Wall Street Journal article, and I just captured the headline on your screen today, but it says, finance teams adapt to closing the books remotely amid coronavirus. And, you know, I started thinking about that. This came out at the end of March. You can see the date is March 31st. So really, for all of us that have worked in accounting, it kind of brings up something near and dear to us, which is month-end close. And something that certainly in all my years as a lease accounting practitioner, a lot of those years spent at Home Depot, this is something that's almost sacred, right, to accountants. We plan vacations around month-end close. We plan even weddings around month-end close. Kids' birthday parties, our own birthday parties, you know, all of that gets driven by month-end close and that schedule. And just reflecting on that and then seeing this in the Wall Street Journal, closing the books remotely. I mean, I cannot imagine over years and years, ever asking if I could work from home during month-end close. Just never happened. But then it did. All of a sudden, right at the end of March, and almost every company was closing the books remotely with people working from home. So just something I wanted to point out and also mention the subheading under this headline. CFOs rely heavily on automation, you know, communication with auditors, and as the first quarter. So not only was this month end, this was the end of the first quarter end close for many companies. So again, unprecedented times and really interesting. But something that really helped companies through this time was cloud-based accounting and the ability using software solutions like we offer at CoStar to close the books remotely. So we're going to be thinking about that as an overarching theme today. And specifically, we're going to be talking about lease concessions, the effects of COVID-19, including lease concessions, discount rate, or the incremental borrowing rate impacts, fair market value impacts, impairment, partial termination, reassessment, full termination or abandonment, also potentially sale leaseback transactions, which may result in the aftermath of COVID-19, and potential information delays. Now, we're going to be primarily focused on lessee-related issues, although some topics also pertain to lessors. And throughout the day today, we're going to be talking about accounting insights and software considerations. And I'm thankful that Tim is here from Deloitte to offer additional accounting insights. And from the software perspective, I will cover many of the concerns from that standpoint. Tim, anything you'd like to add as we kick off today?
Nothing really more to add other than we're definitely in some unprecedented times, and the potential lease accounting related pressure points that may exist will probably continue to evolve over the next several months. So for everyone that's attending today's call, I'll definitely recommend that you stay up to date on any emerging SEC and FASB activity, as well as any of the accounting firm interpretive views that may be developed on these related accounting scenarios. So in that respect, all of the accounting firms have accounting guidance that has been published. So I would encourage you to look at the guidance that's out there, and hopefully that'll help inform some of the decisions you make. I'll now turn it over to Danielle for the first polling question.
Yes, it is that time for the first polling question. The question is, what best describes your understanding of the effects of COVID-19 on your company's leases? Your choices here are no major impact, business as usual, some leases will be impacted, many leases will be impacted, or still evaluating. And again, we're trying to get a sense of what best describes your understanding of the effects of COVID-19 on your company's leases. You have 4 choices here. You will click the radio button to the left of your response and click the submit button to make sure it goes through. And as we wait to make sure everyone gets their responses in, just a reminder that you can submit your questions to the Q&A panel at any point during today's presentation. We should have some time at the end of the presentation to address some of those questions. And we'll give everyone a final few seconds to get those responses in. Final 3, 2, 1. And it looks like we have a pretty big range here. It looks like roughly a third of today's attendees are still evaluating. And it looks like just over a quarter say some leases will be impacted. And it looks like we have a pretty broad range. I'll go ahead and turn the presentation back over to Tim.
Dealing with changes in lease payment strategies and revising payment terms are probably 2 of the most common issues facing lessees in the current economic environment. In this respect, many lessees have either unilaterally decided to change their payments to lessors, or others may have mutually negotiated changes in the payment terms with their landlords. In this respect, questions have been raised as to how these types of changes should be accounted for. The accounting will generally depend on whether the arrangement meets the definition of a lease concession or not. As a reminder, broadly speaking, a lease concession by its nature is a compromise a lessor makes to the original lease terms for various reasons. And generally, in the COVID-19 pandemic, landlords and tenants are reaching out and they're negotiating different payment terms as a means of relief. Some examples of changes in payment habits are listed on the slide, some of which may or may not be considered a rent concession. For example, we're seeing that there are negotiated deferrals or an abatement. A deferral would be a scenario where the lessee will eventually pay the landlord for the rent, but it just may change the timing as to when these payments are made. When it comes to abatement, that may be a scenario where the landlord allows for no payment and is not expected to recover those amounts in the future. There are other scenarios where we see where there's a forgive and extend, so we'll forgive your payments during this particular time frame as long as you extend the lease term. And there are scenarios where we'll see a defer and extend, where the original payments will be required still insofar as the tenant goes and expands the lease term on the back end. Other scenarios that we've seen are short pay scenarios, and that's where the lessee just unilaterally decides to either not pay or short pay the required lease payments. And then certain contracts include co-tenancy clauses that allow for a remedy when there's a change in the economics that were originally negotiated in the lease. So to level set, I thought it would make sense to explain how the ASC 842 guidance would work without the final FASB release that was issued via Q&As a week ago. Under ASC 842, whether the change in payment terms meets the definition of a concession or would be considered a lease modification is dependent on whether the contract provisions provide enforceable rights and obligations for a lease concession. So if you think about the way a contract is drafted, some contracts already have remedies that are baked into the contract. Some of the more notable ones would be a force majeure clause, a default provision, or a co-tenancy clause that would allow the lessee to have a remedy against the landlord in case of certain acts, some of them acts of God, some of them specified in the contract. In this respect, if the contract does include provisions that provide enforceable rights to a lease concession, then this generally would not result in a lease modification. In contrast, if the contract doesn't include an enforceable right for a remedy against the landlord, this would likely result in a lease modification because there needs to be a meeting of the minds between the lessee and the landlord in order to change the payment structure. Now let's fast forward to April 8th. Okay, the FASB, understanding that we are in a world where there's a lot of stress in the system because of COVID-19. The FASB held a board meeting and discussed the current economic environment. At this meeting, the FASB noted that business disruptions and challenges resulting from COVID-19 have resulted, and there have often been some renegotiations as a result between lessees and lessors, a meeting of the mind, so to speak, to discuss how to deal with the period of time where concessions are being made. In this respect, and acknowledging that the ASC 842 modification guidance never contemplated a global event such as COVID-19, the FASB decided to offer some relief to lessees and lessors. This was ultimately provided in the form of FASB staff Q&As that were issued on April 10th. All in, 4 Q&As were issued, and the 4 bullets on this particular slide summarize what each of the Q&As addresses. Now, that first bullet is probably the most important bullet, okay? This first bullet highlights that the first Q&A describes 2 potential methods to account for COVID-19 related rent deferrals, where there may be a change in the timing, but no substantial change in the overall consideration that will be provided in the contract. In this light, the FASB staff believes that it would be acceptable for entities to make an accounting policy election for lease concessions related to the effects of the COVID-19 pandemic. Consistent with how concessions would be accounted for under Topic 842 and 840, if there were actually enforceable rights and obligations in the contract. So effectively, insofar as there's a change in the payment structure due to COVID-19 related rent deferrals, the FASB would not object to companies automatically assuming that the contract includes rights and obligations related to the rent concessions. So when it comes to how this will be accounted for, okay, this particular election is only available for concessions related to the effects of COVID-19 and that do not result in a substantial increase in the rights of the lessor or the obligations of a lessee. So, for example, this election is available for concessions that result in the total payments required by the change in the contract payment structure being substantially the same or less than the total payments required in the original contract. Now, the interesting thing, well, not interesting thing, but the great thing about this Q&A is it goes on to describe two acceptable approaches. The one approach would be to account for the concessions as if no changes to the lease contract were made. Under this model, a lessee would increase its accounts payable as the payments accrue. In its income statement, it would just continue to recognize the lease expense during the deferral period. So effectively, you'll let the runoff of the lease as if it really hadn't changed. You'll recognize the lease expense during the deferral period, and that would allow for minimal changes needed in the system. The other alternative would be to account for any of the concessions and deferrals as variable lease payments. Now, it's important to remind you all that all of the large firms have accounting publications that describe the various approaches for applying this particular Q&A. With respect to the second Q&A, it clarifies that if a company wanted to, they're not precluded from applying the lease modification guidance. So if in a scenario there's a small population of leases and an entity wanted to just apply the modification guidance, the entity can apply the modification guidance with respect to any of the concession or payment changes with respect to COVID-19. As it relates to the third bullet, okay, the third bullet specifies that the relief that's provided by the FASB is not an all or none requirement, meaning that companies, if they wanted to, they could go down the path of applying the relief to certain types of leases, whereas for other leases, they would not have to apply the relief. Now, this is open for interpretation. The FASB was fairly clear, though, that reasonable judgment would come into play and should be applied in these cases. Some examples of how a company may apply the similar characteristics criterion is by type of concession. So if it's a deferral versus forgiving payments, maybe you apply the relief to one but not the other. Another alternative approach would be to apply it by asset class. You could potentially apply it to all of the arrangements where you're a lessee but not a lessor, or maybe even apply it by classification type. So for your finance leases, you may apply the relief, and for your operating leases, you may not. The bottom line here is entities should come up with a reasonable approach when applying the relief and shouldn't cherry pick and abuse the provided relief. Ultimately, the FASB's issued the Q&As in order to help entities make it through the pandemic and the financial or hardship they may be experiencing. As it relates to the fourth bullet, and this is very consistent with other areas of U.S. GAAP, there would be certain disclosure requirements related to any use of the relief that is provided by the FASB Q&As. For instance, an entity should provide disclosures about any material concessions that are received from the lessee perspective and the accounting impact of such concessions. So effectively allowing the financial statement users to understand the overall impact of COVID-19 from the lease concession perspective. I'm now going to turn it over to Matt that will shift gears and discuss discount rate briefly.
Thank you, Tim. So regarding lease concessions from a software perspective, and Tim did an excellent job of giving the overview from the accounting guidance and the FASB staff Q&A standpoint. And practically, after applying the reasonable judgment, and as companies discuss this internally and with their accounting advisors, then the next step for many companies is to evaluate how to enter the lease concession into an accounting software. So what you want to look for in accounting software for lease accounting related to concessions is you want, regardless of what your accounting policy is, regardless of your interpretation and how you choose to apply FASB's relief, your accounting software should record the transactions appropriately. And specifically what I mean is that if you elect to treat the concession as a modification to the lease, that will most likely need to flow through and result in the remeasurement of an accounting schedule in the lease accounting software. And if your election indicates that you should account for the concession as variable expense, or basically a credit to the P&L, then the accounting software should not remeasure the lease accounting schedule. And so basically what you want to look for if you're evaluating lease accounting software or considering how you're going to use your software to account for lease concessions related to COVID-19, just make sure that the different tracks are available for both of those paths, and that the results are auditable even back to the individual lease level. You should have an audit trail readily available. And now, moving through the high-level topics here, that we just covered concessions, which is by far the longest and probably the hottest topic so far. But now we're going to talk about a few more. The first is discount rates, and discount rate comes into play with lessee lease accounting primarily through the use of the incremental borrowing rate. It's commonly just called the IBR. And there are various ways of capturing that rate. Some firms specialize in providing the rate, valuation firms or consulting firms. Some companies have policies that capture the rate based on conversations with bankers, things like that. And you can see on the screen now there's a blog post that's on our website, costarmanager.com. This is just one method. I called it the practical approach to finding the incremental borrowing rate, but you're all welcome to go review that as you consider the rate. But usually the rate that a company settles on is based on a combination of factors. The rates can be based on individual, company-specific factors, such as their creditworthiness, and then also, of course, the economic factors play in as well. And that's really what we're seeing now with COVID-19. Worldwide, we've seen policies, driving toward stimulating the economy as everybody responds to the pandemic. So, we've seen the Fed reduce rates a few times this year, and so that is certainly a factor that plays in as companies consider what their incremental borrowing rate is. Now, one thing that comes up, it's become more of a frequently asked question here recently, is what if our IBR becomes negative, and is that even possible? And well, theoretically, I think we can all imagine from kind of a fiscal policy standpoint, it's possible that interest rates might become negative. But then in practice, and I'd say mathematically it works, right? So even from a lease accounting software perspective, you can create a schedule of negative interest. But really going back to the definition, and I think, Tim, this is something I'd like to have a conversation with you on regarding this slide. Going back to the definition of the incremental borrowing rate from ASTA 42, just to paraphrase it, it says essentially you need to use an interest rate related, to the asset that you're leasing and you need to consider what the interest rate would be if you bought that asset, financed it on a collateralized basis over a similar period of time, and then apply that as the incremental borrowing rate. So really, if you think about that definition that ASC 842 provided, is there really a good argument to be made that an interest rate in the context of lease accounting could be negative?
The reality is this anomaly, meaning a negative interest rate, would generally only exist on a short-term borrowing basis. Okay, the general view has been, and this is definitely a view that my firm holds, is it would not likely go negative from the standpoint of a borrowing for a long-term asset purchase or for any other longer-term arrangements. It's counterintuitive to think that a lender would be willing to provide a loan or financing without having a reasonable return or any return on their particular structure, let alone a scenario where the interest rate would actually be negative. So that would effectively be the lender paying its customer to borrow money. So if there is a belief that your incremental borrowing rate is truly negative, I would definitely encourage you to have a discussion with your accounting advisors or auditors just to validate that your approach is accurate. But similar to what Matt was saying at the onset of the discussion of this slide, we are getting that question on a regular basis. The continuous reduction of the Fed rates and the benchmark interest rates in various jurisdictions, when you do the mathematical equation, could result in a negative interest rate, but generally that would be on a short-term borrowing basis versus a longer-term collateralized borrowing basis. So I'm going to transfer back over to Matt to talk about some of the software considerations related to discount rate.
Great. Thank you, Tim, for those insights. And I agree with you. Although I have told my mortgage banker if she is able to offer me a negative mortgage rate, I will take that as soon as that becomes available. But to recap on that, it is something you want to talk with your accounting advisors about. It certainly sometimes is used in practice. And lease accounting software should be able to accommodate a negative rate if your policy indicates that that's required. And just one more thing on the accounting software side. Here you see an example of the discount rate in the highlighted section of this screenshot. The discount rate being applied to a lease accounting calculation. And one thing that a lot of folks don't consider up front is that there are potentially hundreds, sometimes even over 1,000 different incremental borrowing rates that particularly a multinational corporation might have to choose from at any given time. And so while, on a one-by-one basis, that's okay. You typically think of the IBR in terms of, a length of the lease and perhaps the geography or the currency involved and the type of asset being leased. But if you have operations in many different countries around the world, different currencies, split between real estate and equipment, there can be quite a matrix of incremental borrowing rates to choose from. And so one thing that is an innovation in lease accounting software is the ability to auto-populate the incremental borrowing rate. And that way you can work with your Treasury Department to populate the incremental borrowing rates on a regular basis, monthly, quarterly, whatever the policy is. And then have the lease accounting software auto-populate that when it comes time to do finance versus operating tests and set up lease accounting amortization tables and so forth. So something to consider there that can certainly help in a time of rapidly changing rates like we're experiencing right now. And Danielle, I think that brings up our next question.
Indeed it does. It's time for the next polling question. Your question is, which of the following best describes your company and status for ASC 842 lease accounting transition. Your choices here are non-public company, fully transitioned, non-public company, preparing for transition, public company, fully transitioned, or public company, not yet transitioned or having problems after transition. Once again, we're asking for what best describes your company's status for ASC 842 lease accounting transition. You have 4 options here. Please click the radio button to the left of your choice and click the submit button to make sure your response goes through. And as a reminder, you can submit your questions for today's presenters at any point during today's presentation. We'll have some time at the end of the presentation to address some of those questions. I'll go ahead and give everyone a final few moments to get their answers locked in here. A final 5, 4, 3, 2, 1. And it looks like roughly half of today's attendees say non-public company preparing for transition. Matt, I'll turn the presentation back over to you.
Okay, great. Thank you, Danielle. And that's really good news, I think, and glad to see that non-public companies are attending today. And certainly one thing we learned from the public company transitions and new lease accounting rules is that almost everybody wished they had more time at the by the end of the project. And so that's great that you guys that have joined us today from the private companies or the non-public companies are already on the path. So great news. Moving on through our topics related to lease accounting and COVID-19, the next one up is fair market value. So fair market value, or FMV as it's commonly referred to, is one of the key variables related to lease accounting calculations, specifically the finance versus operating lease test. And one thing to highlight here is that related to COVID-19, that sales are down, and it's really, if you think about it, it stands to reason that social distancing and quarantine type scenarios would, and certainly some uncertainty about when stores locations are going to be able to reopen, when office space will be utilized again. There's somewhat of a dip in commercial real estate sales volumes, which ties into real estate values, and so fair market value is something to consider. And so from a software perspective, a lease accounting software perspective, one thing that I'll highlight here, you can see on the screenshot, this is a screenshot from CoStar, and we're able to provide some data, which might include some market asking rents and comparable rents, and it can be useful in estimating fair market values. And so, this is something that I think I'd like to ask Tim for some thoughts about, because, really the gold standard, I guess, if you want to know what fair market value is, you'd get an appraisal for every asset that you consider leasing. But in practice, I think there are some other policies that companies consider. And Tim, I just wanted to ask you about that. What your experience is regarding how companies determine fair market value.
So from the perspective of what my thoughts and observations are, and again, I'm going to provide a disclaimer, you should always discuss whatever your approach is with your accounting advisor and auditor. I'm of the view that it depends on the nature and the extent of the asset and the assumptions that are available and the materiality of the asset. And in some cases, you may be able to apply more of a qualitative approach versus a quantitative approach for evaluating fair value. For instance, I've seen as a convention for leases that have a fairly short term, and when you look at the remaining economic life, that short term would never get to the point where you're even close to getting to the major part of the remaining economic life. What's done is they provide some rigor around proving out that the rents are at fair value, and as long as the rents are at fair value and the tenant isn't, or the lessee is not leasing the property for that long of a period of time, it may be reasonable to conclude from the qualitative perspective that you would never trip the fair value test. In contrast, if the lease is longer in nature, then maybe a more robust analysis may be needed, more significant quantitative approach. Other factors that may come into play is whether or not there's the experience level of individuals within an organization. So if, for example, it's a less sophisticated organization, there may be a need to engage a third-party valuation specialist, as Matt alluded to. In contrast, some of the more sophisticated organizations may have a real estate department that has the ability to come up with their own valuation. The nature, extent, and amount of documentation related to your fair value valuation of the underlying asset, that is something that'll depend on facts and circumstances.
Excellent. Thank you, Tim.
Yep. So from the system perspective, Matt, did you have anything else to highlight regarding fair value, or should we just jump into impairment?
I think jump into impairment. That sounds great. Thank you.
Okay. So as a backdrop, the ASC 360 impairment model in many respects is new to lease accounting, at least from the operating lease perspective. And my observation is many companies have struggled to understand how to apply the impairment requirements to the right of use asset, just in general. The starting point is determining the asset group when it comes to applying the impairment model. And an asset group would be the level where the asset or a group of assets have their own identifiable cash flows. So when applying the 360 model, it's important to understand what the starting point is. The second point when it comes to the impairment model is understanding when to apply the impairment model. Generally, the way it works is there needs to be an impairment indicator. And at a high level, when it comes to impairment indicators, 360 includes a litany of items to consider when it comes to impairment indicators. So if there's a significant adverse change in the extent the asset's being used, significant adverse change in legal factors, costs significantly in excess of the original amount expected with respect to use of the asset, all of those will factor into the determination of whether an impairment evaluation needs to be done. So now let's fast forward to where we are today. Because of COVID-19, there is significant business disruption and changes in operations. And all of these could be an indicator of impairment to an asset or an asset group. Take, for example, if business goes from having brick and mortar to moving online, or the brick and mortar itself is not holding its value, all of those could be an indicator that there's an impairment. When there is an impairment indicator, then you go to a two-step model with step one, testing for recoverability. So are the cash flows sufficient enough to cover all of the assets in the asset group? And then step two, if you fail step one, would be to recognize an impairment on the asset or asset group itself. Now, as a reminder, if you do conclude that there is an impairment of the asset or asset group, in particular the right of use asset, there is a change in the expense recognition profile. The lessee of an operating lease will lose the straight line expense profile and will move to a single line expense profile, with the cost being the liability accretion plus the straight line derecognition of the right of use asset. So you go from a straight line profile to one that's very similar to the finance lease model, though the combined expense is a component of income from continuing operations versus interest and amortization. As you can very well imagine, this will introduce some complexity from the system perspective, and I'll turn it back over to Matt to highlight what some of those challenges may be.
Yeah, thanks, Tim. I think you said it perfectly. It really does ramp up the complexity when an operating lease particularly is impaired. because it changes that recognition pattern for expense, and really, wherever you are in the schedule, in the orderly flow of information in a software, that has to be stopped, adjusted. There's a loss that needs to be recorded, and then the pattern going forward changes. And so, what you want to look for in the event of an impairment of the right-of-use asset is that the lease accounting solution can record all the necessary journal entry adjustments, and that's at the initial impairment event, and then also going forward that the pattern of the depreciation of the right-of-use asset is changed, and therefore the lease expense that's recorded, as Tim mentioned, is no longer level or straight-lined. It becomes more similar to the pattern of a finance lease, but still recorded in one place on the P&L. So some complexity there, but with a lease accounting solution, certainly something you want to test especially for the private companies that are listening in, something you want to test as you evaluate software, and something that is really quite easy. It's when it's accommodated by a lease accounting solution. Okay, so Danielle, I think that brings up our next question.
It does. The next polling question is, which best describes your organization's experience with lease accounting software for ASC 842? Your choices here are fully satisfied, comprehensive functionality, somewhat satisfied, adequate functionality, unsatisfied, poor or lacking functionality. None have not adopted ASC 842 software or use Excel. Again, a question gauging your organization's experience with lease accounting software for ASC 842. Once you hit the radio button to the left of your choice, click the submit button for your response to go through. We'll give everyone adequate time to make sure those responses get inputted. Make sure everyone has a final 5, 4, 3, 2, 1. It looks like roughly half of the attendees have not adopted any software in this realm, and roughly a third are somewhat satisfied. And then we also have fully satisfied and unsatisfied with smaller percentages here. Tim, I don't know if you're surprised by this, and I'll turn it back over to you to jump back into the presentation.
Thanks. I'm not surprised by what the responses were to the polling question. There are still a lot of organizations out there that are evaluating whether they need to actually get a software to apply to their lease accounting. One thing that I'll highlight is the fact that when it comes to software can deal with a lot of things that Excel can't, and lease modifications would be one of those areas, and that dovetails perfectly into this particular slide on the screen. Okay, what we're seeing based on today's economic environment is businesses may need to reevaluate its real estate needs, maybe reducing its footprint in an existing space. This could result in the need to modify a lease. Now, in that respect, ASC 842 includes a couple of different approaches. And when it comes to reducing the scope of a lease, meaning the reduction of the right-of-use assets subject to a lease, it'll be important to understand these two different approaches because they will have drastically different outcomes. Layer on top of it, when you do a lease modification, including a partial termination, the remeasurement activity will be based on updated assumptions as of the effective date of the modification. So you'll notice that this slide includes two different approaches. So approach number one is the lessee will calculate the percentage decrease in the lease liability as a result of the modification. This percentage is then applied to the pre-modification right-of-use asset to determine the post-modification right-of-use asset, with the difference between the change in the pre and the post-modification asset being a P&L impact. That is what I'll call the accounting version of a modification due to a partial termination. Okay, when it comes to approach number 2, you're physically looking at the asset and you're looking at the reduction of the lease space, and that serves as the basis for adjusting your right-of-use asset and doing the modification accounting. Under this approach, the lessee calculates the percentage decrease in the physical space subject to the right-of-use asset as a result of the modification. So if the lessee goes from needing 10,000 square feet to 5,000, this would be a 50% reduction. This percentage is applied to the pre-modification right-of-use asset to determine what the post-modification right-of-use asset balance will be. The difference between the change in the pre-modification and post-modification balance and the liability adjustment hits the P&L. Now, this particular model is fairly complex, and there are definitely some system implications that I would ask Matt to discuss.
Absolutely. Yeah, thank you, Tim. So when you're in a partial termination situation, I think certainly when we consider the office space, the cubicles that are vacant right now, I mean, who knows? I think there's a lot of speculation about how much office space will be utilized going forward. Maybe some floors of a lease or some square footage related to an office space lease could be impacted. So, and as you consider that, looking at it from a software perspective, really the important thing is that it needs to automate the recording of the partial termination. And as Tim pointed out, there are 2 different approaches, but in neither approach is the adjustment to the right-of-use asset equal to the adjustment to the lease liability. You can see that it could be proportionate to the reduction of the liability, but almost never in a partial termination situation are you going to have equal offsetting adjustments to the asset and liability. Therefore, there will be a gain or a loss associated with this. And so the lease accounting software should be able to automatically book the impact to the general ledger and document the workflows and approvals and an audit trail associated with that. And our next point really has to do with other types of remeasurements, which could come from reassessments. And this is a little bit of a tricky subject, Tim, I think, because the part that's highlighted here from ASC 842 talks about items that are within the control of the lessee. Certainly COVID-19 is not. However, as we go down this list, A, B, C, and D, there is a line somewhere in there where facts do become clear. So I wanted to talk with you, Tim, about the point where a remeasurement may need to occur as circumstances change.
Right, and in that respect, Matt, I just want to remind everyone that there are various liability remeasurement events that will ultimately require a lessee to update its asset and liability. Okay, some of those events would result in not needing to change the discount rate and not needing to reevaluate lease classification. So that would be changes in residual value guarantees, changes in variable payments that become fixed for the remainder of the term. But the most common reassessment event is right here on the screen, and that is when you're revisiting the lease term. And when you talk about lease term, you're talking about the contract has renewal options that were not previously included in the lease term because they weren't reasonably certain being exercised, but now something happens that results in a revisit of the lease term. From the standpoint of COVID-19, from the standpoint of an impairment event that results in a reduction of the right of use asset, all of these are the direct result of something that's outside the control of the lessee. Therefore, they would not be a reassessment event. In contrast, if management decides that they're going to exit a line of business and they no longer need the use of an asset, or they're going to expand the business and they now need to use it for a longer period of time, if they put significant leasehold improvements in a property, all of those would be reassessment events that may result in the need to reevaluate the lease term. And that results in the need to have controls and processes in place to manage it in a manner that will allow you to know to update your asset and liability when an event occurs. From the system perspective, Matt, what are your thoughts on how reassessments are dealt with?
Really very similar to the discussion on the last slide, in that the accounting software solution for lease accounting should follow the company's policy, and it should record the impact to the general ledger. There should be automation in place. Audit trail should be available. And so when management makes that determination, the lease accounting software should automatically record the journal entries required. I think that brings up full termination, Tim.
Yeah, and right now we're in a 2-minute drill to wind down the presentation. So from the standpoint of a full termination, that is a scenario where a lessee decides they're going to vacate a property or dispose of an asset immediately and exit the lease. The accounting for that is fairly straightforward. You de-recognize the underlying liability, you de-recognize the underlying asset, the difference hits the P&L. The one thing I do want to highlight on this slide is if an asset is being abandoned versus being disposed of through a formal termination, there could be some other accounting consequences where the liability remains on the balance sheet, whereas the right of use asset is amortized over a shortened time frame. And I know there are some system implications here as well, so I'll turn it back over to Matt to expand on those.
Absolutely. I think regardless of the modification to the lease, including the termination, a lot of times our customers, their auditors ask for a roll forward report, which basically takes the opening asset or liability balance, walks through the changes that occur throughout the reporting period, and then shows the closing asset or liability balance. So again, something to look for in lease accounting software, and something that should be automated for you. And just a quick highlight here on sale leasebacks. We won't spend much time, but there's a blog post available, CoStarManager.com. You can find this under resources. Sale leaseback transactions, in a nutshell, help you to monetize owned assets by selling them and leasing them back, something that some companies are considering now. And getting really close to the end here, I want to highlight something that actually occurs all the time as we work through month-end close in accounting, and that's just information delay. Certainly with the changes around us right now, information may not be flowing as readily into the accounting department. And so what we have experienced here is that lease accounting software should provide the functionality for automated true-up entries. Now, true-up entries are quite familiar to accountants, and they, as I mentioned, they occur all the time. However, your lease accounting software should streamline that process for you. And now, Danielle, I think we have one more polling question. Make sure you get those in for CPE.
Yes, indeed. It's time for the fourth polling question. The question is, which topic would you like to understand in greater detail? Discount rate automation, retrospective remeasurements, roll forward report, lease accounting reassessment events. I'll leave this poll open for a few moments as we address some questions. I know we're getting to the end of the hour. We started a couple minutes after the hour, so we should have time for at least one or two questions. The first question, I'll address this to Tim. We have less than 100 leases. Do we still need a lease accounting software?
So in my opinion, and again, this is just my opinion and not a Deloitte opinion, anytime you have more than a handful of leases, it is always better to have a software or a tool to put the leases in. When it comes to the initial measurement of the lease, yes, something like Excel may be able to address the accounting, but in the long run, most of the software platforms have the functionality that will alert you of changes in lease term. It'll alert you when there are renewal options that are coming to date. And it also will allow there to be proper management reporting that may be very useful. When you think of Excel and other tools like Excel, it's only as good as the calculations behind it. I think there's more possibility of error when you have manual calculations in something like Excel versus having a software tool that's been tried and proven to be a good tool.
Okay,
that's all I have on that question.
Great, thank you. And I'm going to go ahead and close this polling question in 3, 2, 1. Make sure we have some contact information on your screen. We have time for one more question. I'll address this one to Matt. What is the best way to vet lease accounting software?
Yeah, I think that's a great question. I think really what we see is we go out and present to different companies. We, of course, can provide a demo of software from CoStar, but really I think the best thing that I see as a practice is that companies ask for a sandbox. At the very least, if you're evaluating lease accounting software, give your own real-life examples to the vendor, and then make sure you view those examples worked out in the solution. But then I think the leading practice really is to ask for a sandbox from the lease accounting vendor. Then you can actually put hands on the keyboard and see your scenarios worked out, real time with your experts at the individual companies, trying it out, try before you buy. So I'd say that's my number one recommendation when evaluating lease accounting software is ask for a sandbox environment before you buy. And of course that just helps make sure you're not disappointed when it comes time to be audited or go through the day-to-day process of lease accounting.
Great advice. And now we're a couple minutes past the hour. So Matt and Tim, I want to thank you for a very informative and very timely presentation. And I want to thank you all for joining us today.
Thank you.
Thank you very much.